So you should see a handout like this. Okay. So now in this chapter, which is relating to the master budget, or also called operating budgets, or also means budgeting and planning in some books, profit planning in some books. It's to me, it's I'm devoting 2 days to it, because you can be in any area you want, and according to me, you will be dealing with your budget. You can be in engineering. If you've got project to manage, you need the budget. If you are in marketing, you need the budget. Everything. This is one area which will basically, as I said, you will be dealing with, irrespective of your specialization, irrespective of your major, or irrespective of your interest, you will have to deal with it. So that's why I've devoted 2 days to it. I just want to make sure everyone understands it. In very simple words, budget basically means you're keeping account, you're forecasting something and you're keeping account of it. That's very crude way, but I'll tell you various things. And I'll get started with the chapter 9, I believe. I don't remember the chapter numbers also, but I believe it's chapter 9. So for those who want to know the chapter number. So the first question to you is, you can unmute your mic for about next 5 to 10 minutes. And 5 minutes, next 5 minutes, you can unmute your mic and answer me. First of all, is making a budget necessary?
Yes, sir.
Why?
It depicts a plan.
So we know where we are standing.
Okay. Anything else?
Sir, it reduces the risk and uncertainty.
It reduces uncertainty.
Yeah, at least anything cost will be within the plan, or at least near to the plan.
So for when you have to see whether it is near the plan or not, you have to check it against the actuals, right?
Yes, sir.
Shravani, that's a good point, and we will be dealing with that part as well in one of the later chapters. Okay. Anything else?
Managing the resources.
Pardon me?
Managing the resources.
Nihal, I cannot hear you.
Managing the resources.
Managing resources, very good. What else?
And making the right path of finance to prepare the product.
Mm-hmm.
Using historical data.
Okay. Now, next question is, does the process, read it carefully, does the process of making budget improves productivity or delivery of product or services? Your turn, not my turn. I'll pose the question to you now.
Sir,
Does
it
the
depends. Sir, it depends upon the firm, sir.
No, it doesn't depend upon any firm. Means I'm just asking in general, does the process help in improving productivity, delivery of product or services? Go ahead, please.
I think it's just because they know what the expenses and what their revenue is while preparing the budget.
Okay, if you know your expenses and other stuff.
So if that is known, they'll work upon it, sir.
Pardon me? Go ahead, Nagendra.
Sir, if that is known, the firm will work upon it to increase the productivity.
But that is not due to the budget.
So yes, sir, it will improve the productivity because they'll have to plan within what range of amount they have to get in their resource and what range they have to get in their labor resource or something else and manage within that. So they have to estimate what quality they are going to prepare. So this budget impacts on that too.
Yeah, budget does impact, but does the process of making budget impacts anything?
Yes, so when they are planning it, they will be like controlling it too. Like they will estimate the plan thing, they check with the actual thing. Then they will understand how far they are from the budgeted to actual.
So you're saying that variance analysis might help to control something,
Yes, sir.
but it is not directly, so it is indirectly impacting the productivity. It is not directly impacting the, suppose your accountant or the person who makes the budget goes on a leave for 1 year, would it impact the productivity? Means would your product quality be lower because your accountant has gone away?
Not exactly, sir, because according to my understanding about budget, it is basically the boundary that is drawn to the organization so that the resources can be utilized. But I don't think the process of making budget improves the delivery of products or services.
So process of making budget would not really directly improve productivity or delivery of product or services. Indirectly, yes. Indirectly, everything impacts everything. But just the process of making it does not. Suppose, as I said, if your accountant goes on leave, will you stop delivering product? No.
No.
Would you stop your services? You still continue, right? There's no one to control, that's about it, but it does not impact the quality of the product. Does the process of making budget improves customer satisfaction? Now you're starting to think. Go ahead, don't be shy, go ahead, answer.
No, sir, I don't think so.
No, same
sir.
logic, same reasoning,
No, sir.
okay? So is developing a budget a non-value added activity? So it does not improve product directly, it doesn't improve the services. Is it a non-value added activity? You understand what is value added and non-value added, I'm assuming.
Developing a budget is a value added activity because the organization will definitely know how well their money is spent or how well their resources are being utilized in the manufacturing of the process. So yes, I think it adds value to the activity.
So even though it does not directly impact, but it does add some value, right?
Yes, sir.
So the question is, why do we make budgets? One is it establishes standards of performance, evaluates performance. It is used to evaluate performance against and reward and penalize the performance. It is also used for management by exception. If something goes beyond the standards, then, so if you had budgeted, say, $100,000 for an expense, but your expense now is $150,000. Or in case of many of the governments these days, where you might have planned about $3 trillion, but you have to give $2 trillion in financial help, then your budget is out of whack, right? So it helps to see management by exception. It also helps in in sensitivity analysis, which we also did in cost volume profit analysis chapter. Now, it basically shows you what happens if your, say, occupancy of a hotel changes from 70% to 80%, or if your production falls by about 10%. So it tells you what is the impact on profitability. No one mentioned this, but quantify the current set of corporate strategies and tactics. To me, this is one of the very important things that budgeting does. What does it mean? It basically means that you've got a company like Amazon, or which has offices in, say, 100 different countries, right? Now, or you've got companies like 3M, Pfizer, which are producing medicine all over the world. Now, the CEO of the Pfizer comes and says, our strategy is to improve R&D, right? That's our corporate strategy. So you design tactics according to it. Okay. So as far as, say, Pfizer CEO says we will improve the R&D, how does an employee in India interpret that? So what do you understand by that? If you are an employee of Pfizer and you have been told that our corporate strategy, major corporate strategy this year will be to improve R&D and fight and find a treatment for coronavirus, something like this. So how do you interpret that as an employee?
So that the company focuses their financial, I mean, they spend more on their research and development compared to other parts of whatever they're doing, sir. Like they focus their financial thing also is spent more towards the R&D, like recruiting more people.
Like how much?
Like in the money, sir, like how much?
Yeah, in the money, I understand the spending is in the money. But you might interpret it to be, say, 5% of the revenue, right?
Yes, sir.
But in somewhere in US, they might interpret it as 20% of the revenue.
Yes, sir.
So, but if the Pfizer CEO says that we will spend $5 billion on corona research, so that's a very clear indication as to where the company is going or how much resources is the company willing to devote to it. So that is what we call quantify the current set of corporate strategies. So there is no ambiguity about it. That's how it will bring stability as well. Okay. So budgeting puts a number on it and says, yeah. Now, if a company like Pfizer says we are going to spend $5 million on it, we know that nothing is going to happen over there. That doesn't really bring a shift in the corporate strategy. $5 million for a company like Pfizer is peanuts. Or for Walmart for that matter. Okay. Or say if Amazon says we are going to spend $20 million in automation, nothing. Nothing is going to happen with $20 million in automation. Do you understand what I'm saying?
Yes, sir.
Yeah. Any questions until now, please? Satish, any questions? Tanmay, any questions? Did I pronounce your name correctly, Tanmay? Okay. Next is, it also, when you have budget, you have got level of equipment utilization and how to disposal of assets that have not been used. So you plan for everything in your budget. And then what is the amount of cash needed for each area of business? How much to produce, how much to sell, and so on. Everything is documented. Now, if the budget goals, and anytime when you become a manager, you need to make sure that you understand the impact of your strategy or budget on the human behavior. How are the employees going to respond or react to whatever you have decided, right? You need to understand that before you make any decision. Otherwise, your decision will become useless. There is an old tale, I don't know whether you know it or not, but I'll tell you in short a small story. And this was during the time of kings, and when the kings were there and queens were there. Say, just pick a number, say 500-600 years ago or 700 years ago, there was a small area, a kingdom, where there were a lot of poisonous snakes, and the number of snakes increased so much that it started to bother everyone's daily lives, right? If you go out and you see a snake outside, it's a problem, right? Or if you go into your metro, you see a snake hanging from one of the windows or support bars, then there's a problem. So obviously there was a problem. So king declared that we will give you 1 silver coin for every dead snake. So people started to basically go after the snakes, kill them, and bring it to the king and get a coin. So the population of the snakes went down for some time, but after some time, the population started to increase. Why? It is not an accounting question. It is just come on, have some fun with me. You'll get bored otherwise.
Is it because the goal was to hunt snakes and snakes population got less? It discouraged people.
No, after it went down very significantly. So for some time the goal was achieved, but then it started to increase again.
Is it because of no budget left?
No, king had enough money.
So maybe
Is
is it
there-
because there was scarcity of snakes, so that people started like making it pets, and they wanted the population to boost so that once again they themselves can kill it and get the money.
Yeah, exactly. That's what happened. They just started to breed snakes so that they can take more snakes and get more silver coins. So when you make the budgets or targets and anything, you make a decision, make sure that you understand how the human behavior or how the employees will react to it. I know it's a very crude example, but again, it will drive the point home that you need to understand the implications of the human behavior in any circumstances. So if your goals are too easy, it will lead to slacking off. And if they are unachievable, people will again slack off because it's not within their targets. So you make sure that the individual goals don't conflict with the corporate objectives. And you need to make sure of that before. Recently, you would be listening right now to the news where Mark Zuckerberg, CEO of Facebook, he has basically said he is not going to monitor any statement from President Trump. So many employees left and walked away, and so there was a reaction to it. So you have to weigh what is going to happen, what might happen due to your decision. So as I told you that one of the places I worked was Holiday Inn Crowne Plaza in New Delhi. And right now it is called Lalit Hotel New Delhi. Mr. Lalit Suri was my boss. And this place used to be called Holiday Inn Crowne Plaza, where I used to work. Nice rooms and nice facilities. We had all the usual stuff we have in a good hotel. And this was the entrance. There was a security guard always there, and then there was a security office just when you go further and take a left. This was basically the lobby and the front cashier's office. This was with me. I was in charge of it, and I was in charge of the security as well. And then we had specialty restaurants over here. It was Chinese, Japanese, Mughlai, German, whatever you name, we had a specialty restaurant. And so as I said, the life was good, no complaints. So this is where I used to work once upon a time. This was long time ago, 30 years ago. Mr. Lalit Suri passed away, and then his wife basically kept that chain under the name of Hotel Lalit. That's the history behind it. So Mrs. Josa Suri was his wife, and she basically continued. So get your paper and pencils out and your calculators. So suppose this was a 500 room property, and assume, again, the rooms were not $100 per room night. They were like 200, 300, depending upon different rates now. And in today's rate, at that time, it was approximately, say, 30 years, $100 per night. But it doesn't matter what number you pick. I'll still be able to, I just want to drive a point home. In the month of June, I would call the sales director for a lunch at one of the specialty restaurants we had. And sometime during the lunch, sometime in the middle of the lunch, I will ask him one question. What is going to be your occupancy percentage for the year? So as far as, and from that point on, the lunch basically starts to go down the drain. The sales director starts to curse me in his mind, because now the sales director has to go back, meet his sales team, and start to work on something which is concrete. That is, he has to give me numbers for the next year. Does everyone understand what an occupancy percentage is?
Yes, sir.
Yes, sir.
Okay. So if you understand occupancy percentage, that basically is the number of rooms that are occupied on a daily basis. Same thing for the hospitals. And what I want you to do is assume I'm going to just do it for 3 months. It is the same process for 3 months or for 12 months. Okay. So suppose the sales director gave me the occupancy percentage at 80%, 70%, and 90% for March. I need you to compute the sales revenue for each of the 3 months and the total for the 3 months. And I need you to just type the total for the 3 months in the chat box whenever you're ready. Is the question clear to everyone? Can you all see this, or is that previous slide was better? I'm starting to get the answers. Got 120,000 seems to be the most common answer. 12 million, 120,000, 12 million, 120,000, 12 million. Kaushik, did you want to write 12 million?
Sir, is it terms of amount or is it terms of rooms?
No. Sales revenue. Revenue is always in terms of dollar.
Then it is 12 million.
12 million. 3,615,000. 3,530,000. Okay.
No, it is not 12 million.
Pardon me.
I did wrong calculation. It is not 12.
Yeah, just type in the new answer, whatever your answer is. A few of you still don't have your camera on. If you can, turn it on. And if you're just not on the phone, then you can. Pooja, Revanti, Gagan. Okay. Anyway, so most of the answers is 120,000 over here, and that's why most of the answers are incorrect. So you will have what 120, when you got 120,000, you're giving me 1 day sale only, not for the month. So for the month of January, assume it's 31 days at 80% occupancy for 500 rooms at $100 will give you about 1,240,000. So there was only one answer of around 3,530,000, which was close to the actual answer. So again, February 980,000, assume 28 days or 29 days, depending upon what you assumed. And March, about $1,395,000. So in the actual world, most of you would be wrong on this question, and most of you would have been fired. So I might have saved your job. Nisha, do you know Pooja Shetty also?
Yeah, sir.
Okay. She's not related to you, right? It's just
No, no, no. Coins. Classmate.
Okay. She has not turned her cameras on. I don't know if she has the camera or not, but Pooja, Gagan, and Revati, if you can turn your cameras on. Okay. Any questions over here, please? Does everyone understand it, please?
Yes, sir.
Okay. So I'm assuming you understand this, right? Next is, most of the sales were credit sales because it related to airlines layover or some corporate businesses. So suppose out of this sale, 80% of the sales were credit sales and 20% were cash sales. That is those who walked in the hotel and wanted a room and paid instantly as cash. So now, obviously, all the credit sales were not collected instantly. The bill had to be sent. All the guests will go to different specialty restaurants, sign a bill, and then we will collect those bills and send it to the airline or to the corporate office for reimbursement. So it would take some time, and many times companies will conveniently lose the bills that took us one man day to even put it all together. So 70% of the credit sales are collected in the month of sales. So assume that 70% of the credit sales are collected in the month of sales, and remaining 30% in the month following the sale. What I want you to give me is the total amount of cash collected in the month of February. So once you have the total cash collected in February, type in the answers, please. 1,042,400 from Kaushik, 493,600. Karan, 1,587,600. 2,255,520 from Tarun. You do understand that I'm getting different answers, right? But I'm glad you're trying it out. Okay, so I still don't have a consistent answer, so I'll show you the answer. So 70% of the credit sales are collected in the month of sales. So whatever credit sales you have in this month of January, 70% of this will be collected in January and remaining 30% will be collected in February, right? That's what it means. So first of all, you will collect the cash sales in February, which is 196,000. 70% will be collected from the February, 70% of 784,000. So February sale was 784,000. So 70% of this, and then 30% of the January sale will be collected in February. So if you add the three numbers, there was only one answer that was correct at 1,042,400. Questions? Any questions on 1,042,400, please? Okay, if not, what I want you to do is, instead of February, just give me the collection for the month of March. So if I start to get one consistent answer, I know that you understand it. So same question, instead of February, give me the collections for March. So I'm getting a consistent answer of 1,295,400. One student gave an answer in over 2 million, which on the face of it is wrong because your sales are about 1 million on an average, or close to 1 million. So mostly it's unusual that you'll collect 2 million against your sales. So just on the face of it, that number doesn't seem correct. So you've got a cash sales in March of 279, 70% of 1,116,000 and 30% of 784,000. Whatever that number is, it will probably come to 1,295,400. Questions? And Nagendra, are you okay with it?
No, sir, I didn't get it. I took February's 70% of sales and credit sales, and March 30% of cash sales.
Cash, first of all, again, you are going to collect the entire cash of 279. When you make a journal entry for cash sales, it is cash to sales, right?
Yes, sir, yes.
Nothing needs to be collected. Then for the month of March, where the sales is 1,116,000, we are saying 70% is collected in that month. So 70% of 1,116,000.
Okay, sir. Got it, sir.
And then 30% of 784, because
Got it.
70% will be collected here, 30% will be collected next month.
Yes, okay, sir.
So you can very simply go backwards. 70% of 116, 30% of 784. Suppose it was collected over 3 months, so it could be 70, 20, and 10. So it would be 70, 20, and 10. Are you okay with it now?
Yes, I got it.
Okay. Any other questions on this cash collection? Also, since it is the cash collection, you already know what is a cash flow statement. When you make a cash budget, this cash that has been collected will basically be part of your cash inflow. So 1,042,400 that you have collected is part of your cash budget, and it is an inflow for the company. Similarly, when you make a cash payment, it will be part of the cash budget as well, and you'll show it as a part of cash budget, and it will be shown as a cash payment. Once I was done with this, the further process was to get, I would call the food and beverage director. So I got the revenues for the room rental, which was more or less around 70% of the total revenue for the hotel. Next is I will call the F&B director or food and beverage director and try to get the estimate for the sale of revenue from food and beverages, obviously. That accounted for about 25% or so of the revenue, and the other 5% basically was due to the phone, business, laundry, rental of gift shops, and so on. Once I gave the occupancy percentage numbers to the food and beverage director, he would give me the number of people. Based upon the number of people they're expecting, they will give me the expected revenue from those guests. Once I had those numbers, I will contact the chief chef to get estimate of how much raw material we will need. That is, how much vegetables, how much meat, how much fish, how much beverages, how much liquor, and so on and so forth. So that would be given by chief chef. Once I had that, I would call my housekeeping. Housekeeping was with me. So I'll call the housekeeping and ask them to give me the expenses for cleaning the rooms and changing chocolates, reusing chocolates. No, we didn't reuse chocolates. But basically all the related expenses. Then any other expenses plus any capital expenditure. So if one of those restaurants were to be renovated, for example, that became part of the capital expenditure plan. Or if we wanted to change carpets on 4 or 5 floors of that building, that became part of the capital expenditure plan. So any major expenses that way would become part of the capital expenditure plan. Based upon that, we would prepare the cash budget and financial statements. And when you put all these operating budgets together, it is called a master budget. And then we will take it for the approval of our CEO. So generally speaking, everything started from the sales budget. Sales. So first step in preparing the master budget was we started with the sales. Based upon the sales, we would produce how much do we need to produce? I need to ask the chef how much to produce. Based upon the production needs, we would purchase the raw material or direct material in terms of whatever is needed in terms of vegetables and so on. Based upon the direct materials requirement, if you multiply that price by the purchase price, it will give me the purchase budget. We add to it the direct labor budget. So that was the normal process that would take place. So from the sales budget, based upon the sales of the final units, we have a production budget. Okay. How do you compute the production budget? Again, this is for the final goods, expected unit of sales, plus any desired units in the ending inventory. So suppose you are expecting to sell 100 units and you want, say, 10% inventory from the next month's sale. Then whatever the next month's sale is, say 120, then 10% is 12 units. So 112 units is what is, so 12, so 100 plus 12. Similarly, you subtract what you already have in the beginning inventory, hopefully in a good condition, because you don't want to produce what you already have. That will give you the total units to be produced. Basically, it is as simple as you had, again, as I said, accounting is very simple. Suppose you have $1,000 to begin with, and you made another $5,000 in the day. So now the total available to you is basically $6,000. Out of which, if you spend, say, $4,000, you'll be left with $2,000, right? It's as simple as that. Or you can say, if you had $6,000 and you're left with $2,000, then basically you spend $4,000. Either way, it doesn't really matter, right? Same thing here. You've got expected unit of sales plus desired ending inventory minus beginning inventory gives you total units to be produced. Any questions over there, please? Okay. Okay, go to your handout. Do problem number 1 on provoke operation. On the handout, do problem number 1 on provoke operation. And you can type in the numbers here. I'm starting to get the numbers. As I said, in multiple choice, if you know what you're doing, it will take you about 2 minutes to do a problem. I'm getting two answers, 35,400 and 36,600. Okay, is everyone okay with this, please? Any questions here? Okay, so please note that the production budget is based upon the finished goods unit or the sales. So as I said, the next thing is your purchase budget, because based upon the production, you need to decide the raw material that you need to buy. So the concept still remains the same, like what we had earlier. Same concept, there's no difference in the concept. The only thing is, over here, we are doing it for raw material. Note the distinction, because in the problem, you will be thrown a lot of information. So you need to understand that you're doing it for raw material and not for the finished goods. So as far as the purchase budget is concerned, for the number of units to be bought, whatever materials you need for the production, you add the desired ending in inventory as you have done earlier, subtract the beginning inventory to get the direct materials to be purchased. Now, you multiply that by the purchase price and you have got a purchase budget. So both are related to each other. Another thing which you need to keep in mind when you're doing for budget for more than 1 month, which you obviously will be doing, is that ending inventory of the previous month is the beginning inventory for the current month. So ending inventory for January is equal to the beginning inventory for February. So if at the end of the day, you have got, say, $2,000 available, that's your beginning balance, beginning opening balance for the next day, right? So keep that in mind while you're doing that. And based upon that information, I want you to attempt problem number 2 on the handout, which says Northwest Manufacturers. I'm starting to get the answers. 195840. Any other? Anyone else? The answer is 195840, as few of you have mentioned. So here are the details on that. Materials needed for production for the month of August is 1100 units. 0.5 ounces gives you 550 ounces. Ending inventory is 10% of the following month's production usage. So following month is September, 980 units, 10% of that, and 0.5 ounces. Any questions on 550 or 49, please? Then beginning inventory for the month of August is the same thing as ending inventory for July. So if you have to find the ending inventory of July, it is based upon next month's production, which is August, which is 1100. 10% of that and 0.5 ounces gives you 55. Total units 544, and that's why cost of purchase is 544 times 360. Questions? Okay, any questions over here, please? Anything that is not clear? Okay, so just on the same question, just assume that planned production for the month of October is, say, 1200 units. Okay. And instead of the purchases for August, I need you to give me the purchases for September. So same question, same information, just an additional question for purchases. Is the question clear, everyone? So add October to it, assume 1200 production, and give me the purchases for September. So everyone is getting 183.60. So for the production, you need 0.5 times for September 980. Then for the ending inventory is based upon next month's production, which is 1200 times 0.5 times 10%. And the beginning inventory for September is the ending inventory for August. 980. Next month's production is 980 times 0.1 times 0.5. So 490 plus 60 minus 49. Is everyone getting the same thing? And your cost is 361. Or 360. So everyone should be getting 183.60. Good job. Everyone is getting a consistent answer. So I know you got it. Any questions here, please? Okay, so I'm assuming there are no questions. So I'm moving forward. So basically you got sales budget. Based upon the sales budget, you got the production budget. Based upon the production budget, direct materials budget. Based upon direct materials budget, you've got the purchase budget. Then you add to it the direct labor and any other cost or any factory and other overheads. So once you have that, you've got all these budgets together. From here, you make the income statement and then your balance sheet, and that whole document is called a master budget. So master budget is prepared with a certain set of assumptions, which we started with when we started the budgeting process. So in this case, we started with the assumption that January will have 80% occupancy, February will have 70%, March will have 90%, whatever. That was the assumption that we started with. Similarly, we started with the assumption that $100 per room night is the room rental. So that's our starting point. And from there, we make the budgets for expenses and that whole document, after you attach the financial budgets to it, it's called the master budget. Questions? Okay. Please go to problem number 3 and give me the cash receipts for Grainger Company in the month of February. And type in your answers. So got one answer, 114,000. Any other answers, please? Okay. So, yeah, you're right. The answer is 114,000. So in this case, your collection is 50% in the month of sale, 30% in the month following the sale, and 19% in the second month following the sale. So you've got February, 50% of February, 30% of January. And then it tells you that your account receivable balance as of January 1st is 58,000. Out of that 58,000, 35,000 is collected in January, and the remaining amount will be collected in February. So out of 58,000, 35,000 was collected in January. Remaining 23,000 will be collected in February. Okay. So the total of these three is 114,000. Questions? Okay, what I'm going to do is for next 5 minutes, from the same piece of information, what I want you to do is give me cash receipts for March, same information, cash payments for February. So I need you to add these two questions to the list using the same information. And I'm going to break you up in groups, and I want you to work it out in groups for 5 minutes or 10 minutes, maybe 5 to 7 minutes. It's 9:20 a.m. my time. So around 9:27, I will call you back into the main group, see how it works out. That will give you a break also from me. Okay? Is everyone okay with that?
Yes, sir.
Yes, sir.
Okay, so I'm going to break you up in breakout rooms, and you can talk with each other, see, stretch yourself. And I see Ashlesh is already feeling restless now. So I will give you a few minutes to stretch and so on and talk with each other. Okay?
ಮತ್ತೆ ಅರ್ಥ ಆಗ್ತೈತಾ? ಆನ್ಸರ್ ಕಳಿಸ್ತೀನಿ, ಆನ್ಸರ್ ಸಿಕ್ಕಿದೆ. ಯಾಕೆ ಹೇಳು, ಸರ್ಗೆ ಹೇಳು ನೀನೆ. ಕೇಳಿಸ್ತಿಲ್ವಾ? ಮಮ್ಮಿ,
Okay, is everyone back in the main room now?
No,
Okay, are you good for the cash receipts for the March? What is the answer for cash receipts for March?
Sir, 95,500.
95,500. Is everyone getting the same number?
what, sir?
Cash receipts for March. One of the answers is 95,500. Is everyone getting the same number?
I am getting 118,300, sir.
Oh, you're getting different numbers. 118,300. Okay, so we need to redo it then. Any other number?
118,500.
I'm getting 118,500.
118,300, sir.
So 118,300.
So this seems to be the more popular one. Okay. So this was for March. So 50, 30, and 19. So 50%, 30%, and 19%. So 50% of March, 125,000, 110,000, and then 120,000. So 118,300 is what most of you are getting. So now the question is why others are getting a different number, please.
So I didn't calculate with the 19%. So for the January, so I got the wrong answer.
Okay, so you need to include the 19%, so you know the problem now. Any other question?
No, sir.
What happens to the 1%?
It is
End of the
expensed
year.
at the end of year, sir.
End of the year, sir, December.
Pardon me?
It is expensed at the end of the year.
Yeah, so it is not collected, so it will not impact the cash inflow.
Yes, sir.
It's an uncollectible, so you're basically charging it as a bad debt expense at the end of the year. Okay. Next, cash payments for the month of February. What are your answers? Okay, cash payments for the month of February. What are the answers, please? Did you get it?
I got it as 211,680.
211?
680.
68.
0.
Okay.
680. Yeah.
Okay, any other number, please? Yeah, so cash payment for February, it tells you that Granger pays for all purchases by the 5th of the month following the purchase. So basically they are paid everything by the 5th of the month, right? So in the month of February, you've got a balance of accounts payable of 72,000. When is this going to be paid? When is 72,000 going to be paid?
The month of July, sir.
January, it's a January accounts payable paid in July.
For Jan, it is June, sir. 5 months from January.
Where are you getting 5 months?
Sir, it is paid.
It will be paid in
February 5th.
By 5th of February.
5th of February.
5th of February.
Yeah, where are you getting June, July? I don't even see it here. It says it will just be paid by the 5th, not the 5th month. 5th of the month, not 5th month. I guess you're getting mixed up with between the 5th month and 5th of the month. 5th of the month means 5th of February it will be paid, right? So you got $72,000 from that right? Plus, it says the monthly expense figures include 5,000 of depreciation. The expenses are paid in the month incurred. So you have got, for the month of February, you have got 24,200, but you take off the 5,000 of depreciation from there because that's a non-cash expense, depreciation to accumulated depreciation. So you'll come to about 91,200. Does everyone understand that, please?
Yes, sir.
Depreciation is taken out because it's a non-cash expense. You don't pay that, so it doesn't impact your cash. Okay, give me the cash payments for the month of.
Sir, can you explain it again?
Sure.
Yes, sir.
So let's see about the cash payments for the month of March, okay? So in the month of March, your purchases of February will be paid, right? So February purchases will be paid by 5th of March. That's about 66,000. Your expenses of March will be paid, which is about 27,000. But out of this 27,000, you've got a depreciation which you don't have to pay. It means that's a non-cash expense, right? So you've got 66 plus 27 minus 5.
Sir.
Excuse me, sir.
But it's also mentioned that to take advantage
3%
of 3%
discount.
So we have to reduce that 3% from 66,000. So that.
Yeah, if you have 3% off, then it will be 97%. My mistake.
Yeah.
Just a second, let me finish. Advantage of 3% discount. So this should be 72,000 times 0.7.
So that is 78,000. 78,000 into 3%.
The purchases for January
is 78,000.
Yeah, purchases were 78,000, but accounts payable on January 1 is 72,000. So they might have returned some goods.
Okay.
Sir, I have one doubt, sir. If at all the accounts payable is 72,000 and purchases are from Jan are 78,000. So the difference 6,000 amount, where will it get carried to?
It could have been purchase returns, or it could have been paid extra. Some extra payment may have been done in the previous month.
Okay.
But generally a return you can assume.
Okay, sir.
So if you have to take advantage of the 3%, if that relates to the purchases, then
Sir, but I don't get one thing.
Yeah.
Account payable is the beginning balance of January. So the purchases shouldn't be linked with that. So purchases 98,000 is incurred after that 72,000. So.
Oh, you're saying the purchases of 78,000 were made in January.
In January, yes.
Yeah.
70,000 is the beginning balances of January, so we shouldn't consider accounts payable, I guess.
Oh, so that would be paid on January 5th, not in February.
Yeah.
Yeah, January 1st balance, you're right. The January 1 balance will be paid in January, not in February.
Yes.
So it should be 78,000.
8 into yeah.
And then this should be for March, should be February's 97%. Okay. Good catch. So for February, this was your January's purchases at a 3% discount. This was your expenses, including depreciation, less depreciation. Is everyone okay with the cash payment in February?
Yes, sir.
Okay. Cash payment for March. February's purchases of 66,000, 97% of that, plus expenses minus the depreciation. It'll give you March purchases. Same thing for April. You got March purchases. March purchases are 81,250 times 97% of that. Expenses for March. I already did that, right?
We are doing for April, sir.
Sorry, April. That's what I thought. April is 28,600. And your less your depreciation of 5,000. At about 102,430. Now, all this cash payment will also become part of your cash budget when you make the cash budget. So how does a cash budget really look like? You've got the opening balance of cash, add cash receipts, less cash payments, gives you the closing balance of cash, which basically goes to the balance sheet. Okay. So if you were making the cash budget for, say, February or March, you will use those as your cash payment and cash receipts. So in this case, you had got the cash payments at 94,860. 94,860 and then 86,020, right? Your cash receipts we did worked out for March was 118,300. So your cash receipts 118,300. So you get the idea, right? So when you make the cash budget, and if there is no opening balance of cash, then it is zero. Otherwise, it will be given in the balance sheet. And at the end of it, you'll have a closing balance of cash. So you got any opening balance
Yes, sir.
plus whatever cash?
88,000.
Pardon me?
88,000 balance.
Pardon me? There was a question over there, please.
Yeah, no. Opening balance cash is 88,000. That is what I asked.
Opening balance is how much?
88,000.
Yeah, 88,000 is given to you. Okay.
But that is for the month of January, right?
That's for the month of January. That's true. Not for March. So why is it going to be here? So whatever the balance of February is, will be the balance for March, right? Whatever the closing balance of February will be there, will be the opening balance for March, not 88,000. Got it?
Yeah, I got it. But
Okay.
this 88,000 is included in 94,860.
Pardon me?
Is 88,000 included in this 94,860?
No.
Or like, since it is January's.
Yeah,
it is for
January. See, again, I don't have the full numbers over here. I was just trying to make an example here. So it was, if you have something in January, then you got an opening balance of 88,000, and then whatever the cash receipts are, less cash payments gives you the closing balance. That becomes the opening balance here. Whatever the cash receipts are, less cash payment, and so on. And if you are short of cash, then you borrow that money from the bank. And if you borrow that money from the bank, you have to pay interest as well on that money. Okay. Are we good on this, please?
Yes, sir.
Any
Yes, sir.
questions? Yes. Yeah, go ahead, please.
No question, sir. I answered your previous one. Like, we're good with this.
Okay. Any other question from anyone, please? Okay. Okay. Please do number 4 on Davidson Enterprise and number 5. So I'm going to put you back in the groups for 5 or 7 minutes. It's 9:47, so you'll be in the groups until 9:55. Try to do the next 2 problems. Okay, is everyone with me now?
Yes.
Okay, does the breakout room work for you guys?
Yes, sir.
Works, sir.
Yes, sir.
Okay, it's okay, means over there. You're comfortable with the idea?
Yes, sir.
Okay.
Yes, sir.
So here are the answers for your questions for this remaining handout. So as far as the Granger's cash collection in February, we already did that part. Davidson Enterprise, if you got the answers at 6,000 units, 60% and 40%, and 12,500 units and $100,000 in account receivable balance. Those should be your answers if it is correct. Otherwise, you can note down the answers on it. Has everyone noted at least the answers down or checked it, please? So part A would be 6,000 units, part B will be 60%, C will be 250,000 and 12,500 units. D is $100,000 in account receivable balance. Okay. So note down the answers, make sure you're able to get it. For the Terra company, if you have the answers right, it's 42,200 for part A. Or you can note down the answer and match it later. For part B, your answer is 132,700. Also for the sale of October, November, and December added together for the quarter is $132,700. Now, so that would basically take care of the handout. I want to, on Monday, I will do some problems from the, just try to do all the problems on the Connect. I will answer any questions you have on Monday. I'm also going to send you another handout on budgets. So since you'll have enough time between now and Monday, I want you to complete that handout and bring any questions you have to the class on Monday. So you'll receive another email for Monday's class, which will have a handout with the problems on it. And if I'm also keeping the recording links on D2L. If you need to look at the recording for any reason, it is also available through D2L on So I'm assuming you know how to access D2L. So if you go to the D2L, I'm sending that to you on the email also. And I also have it on the, under the contents. So under the tab of Zoom recording, Dr. Maheshwari Summer 20. So you've got the first 2 days of recording here, if you missed anything. And then today's recording, I'll put it in about in 1 hour's time or so. Okay, that brings me to the end of my time. Questions, any questions, clarifications before you leave?
Sir, chapter 8, first question, I didn't get it, sir.
Chapter
in absorption costing, I got it, and variable costing, I didn't get it.
This one?
Yes, sir.
So what is the issue you said? Which part?
Sir, variable costing. And the next one, third one, sir. Same and above.
Yeah, the third one is same under both because your production and sales are same. So if you remember what we did yesterday was, if your production is more than your sales, your absorption costing income is higher, right?
Yes, sir. Yeah.
And then the reverse of that is true. That is, if your production is less than sales, then the variable costing income is higher. Because under absorption costing, more inventory, more cost gets inventoried. It goes into the ending inventory. So you charge less. In this case, when you sell more than the produce, where is it going to come from? It's going to come from your beginning inventory, right? Whatever you have in the inventory. So that cost gets released. And that's why your variable costing income is higher when you have got the production less than the sales. And if it is same, then it is same under both. And the difference is primarily due to the fixed manufacturing overhead for the two. Now, does that help any or no? Or?
So can you show the calculation how you got 44,720, sir? I didn't get it.
There's an increase in inventory by 5,200 units. That's why there's a decrease in inventory, so it gets released from the beginning inventory. So your fixed overhead rate is $8.60. You know how to compute the fixed overhead rate, right? So the difference is for 5,200 units. So 5,200 times $8.60 gives you 44,720. Same thing here. The difference, the per unit overhead cost, fixed overhead manufacturing cost is $8. The difference is 2,200 units. So if you look at the difference between the two, 98,900 and 96,700, that is $2,200 difference, 2,200 units difference. And for each unit, you multiply it by the fixed overhead rate per unit. because the difference between the absorption and the variable costing is due to just the allocation of the fixed manufacturing overhead to the cost of goods sold under absorption costing.
Got it, sir.
Got it?
Yes, I got it.
So that is the only difference in the whole chapter. Everything revolves around this fixed manufacturing overhead per unit. Because the difference between the two is due to this one thing. And we did we did one of the problem number 4. Do you understand the problem number 4 we did yesterday? Or try to go over the lecture which has been recorded for you from yesterday's class. And then if it is still not answered, I'll be happy to take it up again.
Thank you, sir.
Is it answered or not? I'm not sure from your face whether.
Yes, I got it.
Okay. Because if it is, you should always ask again. There should not be any hesitation in asking me again.
Okay, sir.
Okay. Okay. Any other questions, please? And if you look at one of the slides which I showed you, remember the slide I showed you? It basically summarizes everything. If the units produced are greater than the units sold, your inventory will increase and your fixed manufacturing cost expense to the absorption costing will be less than the variable costing. That's why your income is more. If you're charging less expense, basically your income is more, right? And if you're charging more expense, your income is less. That's it. Means that that's a simple explanation. And again, if there is a debate, again, go through this PowerPoint or go through the, again, I showed you that in one case, you're charging it at the rate of $16. And in one case, you were charging it $10 because of this fixed manufacturing overhead of $6. So try to look at the recording from yesterday's class, and then it should be clearer.
Okay, sir. Thank you.
Okay. Any other questions or clarifications, please? Okay, so have a nice day, everyone, and be safe on the weekend. And I will pick it up here on Monday. I'll see you at the regular class time on Monday. Have a nice day. Bye.
Thank you, sir.
Thank you, sir. Bye.
Ashlesh, any other question left, please? Revati.
No, sir.
Revati, any questions for me?
No, sir.
Okay, take care then. Bye.